Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I'm your host, Neville Hicks, alongside Christophe Barnett. In studio this morning, we have a fellow investment professional, a CFA charter holder, and the incoming president of the CFA Society Cayman Islands. Welcome, Jessica Jablonowski.
Good morning.
Thanks for joining us.
Thanks for having me.
After being, in business or operating now for the better part of 2 years, we've listened to our listeners and gathered up a number of questions for various topics, including personal finance to investing. And we've kind of decided to dedicate this show more to a Q&A from our listeners and our audience and kind of answering some of the questions. So we do want people to continue to give us questions, and you can do that at MoneySense or MoneySense at candw.ky, or you can tweet us at our at MoneySense handle, as it is the Twitter handle. So if you do have any questions, or if this show spurs further discussions, please send us an email, and we'll do our best to try to give you some insight into the world of personal finance or investments. So with that, I guess the first question, I think this comes up quite a bit, and I'll just kind of lob it out to either Christophe or Jess here, is just about home ownership and whether or not, that seems to be a very popular asset class. Is home ownership something that is a good idea, or is that a good investment?
Well, I think we have to first separate, are we going to live in the home, or is it an investment property that's going to be rented? Because I think a lot of people think when they live in a home that this is also an investment, but it's simply a replacement of the fact that you would have to spend and rent. Mm-hmm. So the way I look at it is, if you live in the house, it's an expense, and if you buy it as an investment, maybe you can get some income out of that.
Right. And I think I would kind of add to that, an investment property can be a good investment as long as you've got it tenanted and your rent payments stay ahead of inflation and any maintenance or insurance expenses on the house. And I'd agree that it's not necessarily an investment if it's your primary residence. It can increase in value over time, but long-term studies have shown that home prices essentially just track with the rate of inflation, which is not bad for an asset, but it is also an expense. But living expenses, you're going to have them wherever you're living. So you're either paying rent or you're paying into a mortgage. So you have that expense regardless. I'm
glad you mentioned about the fact that of course, the house you live in can increase, may or may not, because I feel like that was the pushback. Right as soon as I say that, I can hear our audience saying, "Oh, but my house went up in value," or "I sold this house, I bought this house for the X and it went up, over this." So obviously it can, but what Jess mentioned is critical. That long-term studies of broad swaths of real estate have shown the data she mentioned, when of course we can look at specific areas and communities, especially Cayman. Obviously prices have gone up. We see 7 Mile Beach, but then we can also have Cayman examples of areas in Cayman that haven't really changed in the last decade.
So I guess just getting back to, if it is your primary resident, often when you ask people, well, what is your biggest asset? Mm-hmm. Well, I think their biggest asset is actually their future cash flows that they're going to generate, or their income that they're going to generate. But more often than not, they go, well, my biggest asset is my home. And
it's also their biggest liability a lot of times.
Right. So if you have debt on it, and I think effectively kind of that's the kind of question mark. But I think you raise a good point as to because it's an asset that isn't valued. So you look at a stock, oh, well, I'm up 5% this day, or I'm down 10% this day. You don't see that, or it's not as transparent with real estate. So it's kind of one of those things. Well, I haven't lost money, and you mentioned this earlier. Well, yeah, but it's been you've had it listed for 10 years. It's probably not worth what you think it's worth. So that's certainly something that comes up.
Well, I mean, and then we can talk about, okay, given all of that, should we own or should we rent, right? It's always the question. And I think it depends what you value more, right? So there are a series of what's called real options that you get when you own the asset. So you have the option to change the layout of the house. You have the option to buy new furniture and knock down a wall and put in a wall, put new fixtures in, whereas your landlord might not, or landlady, as I had for many years, wouldn't necessarily be the happiest if you started knocking down walls. But when you rent, you have the flexibility that if you want to change locations or a new job opportunity comes up, you can move. So it comes down to a personal preference, and there's a level of commitment with the owning as well. Those are things to think about.
Certainly. Another question from a listener is, should I invest, and I'm not sure into what, or pay down my debt or credit card?
Well, this is sort of a multifaceted answer to this question. So if someone says, should I pay down my debt, or I have this investment opportunity, right? I can make 10% a year, or I could pay down my mortgage because I have some spare cash laying around.
Mm-hmm.
Well, okay, we can talk about that. Let's put a pin in that for a second. What if it's credit card debt that's charging you 20%? Well, let's start with that.
Yeah,
right?
let's start from the highest tier of interest rate.
Exactly. So let's start by paying down the highest rate, because could you borrow on a credit card at 20% and then invest and make 50%? It's possible. But you could also lose 50%, right? So, and then you still have that debt. So start with the highest rates. And then it's just, what do you think when let's say you start getting to when you just have your long-term debt, 4 or 5%, and you have some investment opportunities. What do you think in terms of, should the debt be paid down or take the chance on the investment?
I mean, I think it depends on the investment opportunity, and like you said, you want to focus on your rate of return there versus your interest, your debt payments. So, if you're talking about a mortgage and you're paying maybe 4 or 5%, and you think you can have an investment that's likely to return 10% with a reasonable amount of risk, then that could make sense. But likewise, if you're comparing this to credit card debt that has a much higher rate of interest, then the investment likely doesn't make sense.
I guess it depends how certain are you about the investment return, right?
Mm-hmm.
We can be reasonably certain about the mortgage rate. Rates change. We might have a question about that coming up, but let's say we're reasonably certain mortgage rates are going to stay at 5. If you have a investment that's reasonably certain to get you 10, well, then maybe that's something to think about.
Right. I think if you looked at a textbook for an answer, you said, okay, well, if my debt, you obviously should pay off your higher debt 20%. There's very few investments that you're going to get a return of 20% per annum consistently. From a credit card standpoint, you're going to be charged 20% per annum. Plus fees, plus late fees, plus bank fees. So all of that adds up. And typically your credit card, I mean, I don't know what your guys' limit is, but it typically is a smaller amount. But
smaller than your house, yeah, for sure.
Certainly. So, I think getting rid of that primary. So, let's say you get a bonus or you get a kind of a windfall of cash.
Or just saving, right?
Or saving, too. Exactly. I think people should, oftentimes we as a consumer society go, well, I've got this money. What do I do with it? Meanwhile, you're paying 20% on your credit card. And that just is, that becomes like a car payment on a monthly basis, and you don't even realize that. So from a consumer standpoint, you're going, oh, well, maybe I'll buy a watch, or maybe I'll go on a trip. When really, the long-term benefit of paying off your high-interest credit card, your high-interest debt, has a huge, huge advantage going forward.
One other aspect is it may not be an existing debt, right? So going back to the home ownership or an investment property, let's say there's a rental property and there's a small duplex or a small house that you know you could rent out. Well, maybe it's worth to get a loan on that. So you calculate how much you can get in terms of rent. Can it cover the mortgage payment? So you're taking out a loan to get that gain, that investment gain. So it's sort of a different way of looking at it.
Yeah, I think that's a good point, and that's when, you know, buying a home can be a good investment. If you're putting, say, $20,000 down on a $100,000 home, and you know that you can get the mortgage payments covered by your renter, then they're essentially, you know, you put in that initial investment and you make a return. If you have it rented for the next 15, 20 years until the mortgage is paid off, they've essentially, you know, generated that return for you.
But I guess that leads us to the next question that we had from one of the listeners was, why do interest rates or mortgage rates go up or down? And I think that ties to this conversation really well, because that renter might be able to cover it at the current interest rate. But I don't know about you guys, but in the last 18 months, my mortgage has gone up by 1% as the Fed has increased their rate. So all of a sudden my debt service or my level of debt or my level of interest payment was XYZ. And when I started out, or I anticipated, and now I'm paying more. And I'm sure there's a lot of listeners who can feel the same pain. So why, you know, I guess the question it really is, why has that happened? Why have, in, you know, the last 18 months we've actually seen interest rates go up, which has been the first time in the better part of 9 years?
We've on previous shows, I think we've talked about the Federal Reserve and the setting of interest rates, but just to take a step back, we can think of interest as the price of money, right? So if I want $100 and I want to pay it back for a year, how much will that cost me? That's interest. It's the price of money. And in a free market, it would be set by, some people have some savings and some people need to borrow, and so there'd be a meeting of the minds, and that's how the interest rate would be set in the market, like most other goods. But in our current financial system, our currencies, our monies are controlled by the central banks of the issuing countries. So we live essentially on a dollar standard here in Cayman, and so the money policy is set by the Federal Reserve in the United States. And they have taken that role from the free market largely and set the interest rate at which they will lend. And so they will literally just credit people money in a computer system. Banks have accounts at the Federal Reserve, and when a bank needs money, they will credit that bank. And so
the bank will be required to remit
the bank has to
interest
pay it back.
at that level.
Yes, and so they essentially set that rate, and that's the lowest rate that exists. And then all other interest rates sort of exist at various points higher than that, depending on the risk of the borrower. So by the time it gets to us as a mortgagee, then it may be 4 or 5% higher. More for a car loan, more for a credit card. Just this is kind of how these things work. So then how do interest rates go up and down? Well, it could be based on you as a borrower. Maybe there's things you can impact. But in terms of the base rate, it's just the money policy of the Federal Reserve, just based on if they want to help the economy.
Okay, yeah, that's a good summary so far on interest rates. We're going to take a quick break, but please continue to listen. We'll be back to answer all your personal finance and investing questions. Good morning and welcome back to Money Sense. I'm your host, Neville Hicks, alongside Christoph Barnett. We have in studio with us Jessica Jablanowski, CFA, and we're here answering your various investment and personal finance questions. So we ended there talking a little bit about interest rate and mortgage rates, why they go up or down. We talked about the Fed. I guess for our listeners, we're in an interesting time because we've actually started increasing rates. And this is the first time in a number of years. We've obviously gone through the financial crisis where we saw, I guess, the Fed rate or our base rate go basically to zero. I guess if you look back even to the 80s, we've come, I don't know, what was the base rate back then? 14%?
Yeah, 14, 15. Yeah.
So we had a 30 plus year run where we've gone from 14% effectively to zero. And we've now bounced off that zero line, and the Fed has effectively been increasing. So in the last 18 months, I'm sure listeners have noticed their interest payments going up. I think one of the questions I have, and I put it out to you guys, is that going to keep going up? What's your take? I mean, do you think the Fed will keep increasing? Do you think our listeners will keep having bigger mortgage payments?
Yeah, I mean, I think it's going to depend on what the economy does, and that will drive the Fed decisions on whether to continue increasing. And from here, we haven't even reached a normalized level of interest rates in the U.S., though. So
that's a good point.
I think we do continue to see a bit more of an increase, but over the long term, I hope we don't see anything. I personally don't see the economy taking off wildly enough that we're going to see a drastic increase over the next couple of years, but. We will continue to see them take measured steps towards a more normalized rate environment, because when we do reach the next recessionary period, they want to have, some leverage to lower rates again if needed.
And let me ask, so the Fed rates, it's hard for us to control. We sort of have to take them as given. But for our own personal loans, is there anything that we can do to lower our own rate or to have more control of that?
I think pay your bills on time, work on your credit score, take out less debt versus an asset. I mean, I don't know, speak to your banker and say this, I'm not happy with this rate. I mean, it's from a mortgage standpoint, I don't know how much kind of leeway is baked into that. I think ultimately, they look at the lending value of the asset and your overall debt service, which effectively is your income less your expenses and over your borrowing costs. So the higher that ratio is, I guess the more beneficial rate in theory, or the better credit quality you are as a borrower.
Mm-hmm. Well, and I'll just add one thing: we can't necessarily control the interest rate, but we can control the interest total that we pay by what you just said. If the more debt you pay down, the less interest you pay. So that's one thing we can control, which goes back to our question of whether you should pay down or not.
But I think, Jess, you bring up a really good point about what normalized, or I guess if we look back in history as to what is a normal interest rate. And another question, which I think we kind of get this a lot, and I think a lot of it is lost a bit in translation, and a lot of it is this, we actually see it and we feel it, but we don't necessarily understand why it's happened. And really the question is, what is inflation? And maybe I'll lob that out to Christophe to get all philosophical, and then we'll go on to more practical purposes.
Yeah, well, we'll start technically. And so inflation is the general increase in the level of prices. So, okay, that sounds kind of dry, but where it matters is when you go to the grocery store and that half gallon of milk now costs what the gallon used to cost a few years ago, and similar for other goods, or your rent is higher, or the
gas,
you name it.
Coffee, the coffee I'm drinking right now.
School, health bills, insurance.
The mango.
So it's just the general. So that is what is inflation. Now, what causes inflation? Well, that's a whole another level of complication, and that's, I guess, something we can talk about. But
what does drive? Why am I drinking a coffee where I don't know what it cost me? $2.50 CI. Well, why did that cost me $2 3 years ago?
Well, what's interesting is I remember as a kid when I first heard about inflation, I thought that just every couple of years businesses were greedy and just would increase the prices. And that still might partially be true. But I remember that was my first thought when it came to inflation. And it's only afterwards that I realized I mean, just because of the history and the research that shows that basically when there's more money trying to buy a limited set of goods for the market to get back to equilibrium, the prices have to increase. So it's one thing we see is if you have new buyers coming in, let's say to the real estate market in Cayman, well, that's new money chasing after we're not creating more land. We can build new houses, but there's no more raw land. And so more money chases those assets and increases the price. So it's the same thing that happens. Products are scarce, and when we have more money in the system, because of central banks, because of you name it, just general productivity, it leads to more demand for the prices, and then for the products, and the prices rise.
Right. So I think if we look at, so let's take Cayman for instance. With a lot of stuff imported, what I guess we're subject to inflation in other countries.
Correct.
So take the coffee as an example. If we look at so how is the coffee made? Well, the coffee bean prices, I guess the price of water, and ultimately, what the import costs are with that, and then what the price of the business that charges, how that flows through to the ultimate consumer.
I mean, that's sort of a supply and demand effect, and it gets complicated because then we look at something like a computer, whereas over the last 10, 15 years, the price of the computer has gone down and it's gotten better. So to get a computer that was as powerful as you got 10 years ago, it would cost nothing. And so there's supply and demand effects that counter or enhance the level of prices. So this is where it gets complicated. People think, well, my cost of living is going up just because I feel poorer, but it's hard to necessarily pin down. That's why inflation gets complicated. And I'll ask Jess to tell us about shrinkflation, because I think that's one thing that people definitely see, and it's kind of infuriating. So you go ahead.
Yeah, you're a little bitter about your Toblerone bars getting less chocolate. So shrinkflation is, let's take a bag of chips, for example. You go and buy a bag of chips in the grocery store. It costs you $3, say, and maybe a year later you go and buy that same bag of chips. It still costs you $3, but there's actually less chips in the bag because
more air,
less.
Yes,
chips.
they pump air in to make it look like a full bag, but it's actually maybe only half a bag of chips. So businesses have taken to providing less of their product within similar packaging, just to cut costs from their end.
Right, but at the same cost in a way. So it's almost as though they're just giving
prices are the same.
Back to the coffee. If I bought the same coffee and they only gave me half a cup, right. Or the classic is they had the X-ray machine and they were looking at sticks of deodorant, and the bars in it, there was only half of what there should have been. Yeah.
It's actually
and the Toblerone bar where they cut the top off the mountain.
Exactly. There were less. If people can visualize a Toblerone bar, there are less triangle wedges now than they used to be.
Skinnier.
And skin,
it looks funny.
The infuriating one, you can see YouTube videos about this, is they have the containers that are opaque, so you can't see how much is inside, and then until you go home and you open it up and you look inside and half of it is air, right? I guess you could shake it up, but it's just infuriating. Like, why not just fill up the whole thing and charge? The reason is they don't want to make you feel like the price has gone up. Oh, no, the price is the same. No, but you're getting half. And we're not stupid. We know what's happening.
Yeah.
So shrinkflation, that's another way business have kind of got around or not combat it, just basically tried to fool the underlying customer. And we talk about the long-term normalized rate of interest. What I keep hearing, historically, if we look at what should be inflation, various governments, central banks, and very famous economists talk about 2% inflation. Is that number? Is that relevant anymore, or is that still something that they should target, or we should target here in Cayman? Or, obviously there's multiple things, and it's difficult to actually pin it down and make it, I guess, go to where you want to go, because there's all these moving parts. But is that, in theory, a reality, or is that something that government central banks should be working towards?
So without getting too technical, there's two things that we want to avoid: high inflation and high deflation. Right, so we want prices to be stable. You want to know that you can go to the store and buy what you normally buy for about the same price. And with high inflation, prices keep going up, and so there's all that uncertainty. And
think of Venezuela or
correct, we've our wheelbarrow full of cash that we've seen in the history book. But what people don't think about so much, because we haven't seen it almost by design, is deflation. If the general level of prices is decreasing across the total economy, then it makes sense for me not to spend my cash, because tomorrow will be worth more. I can buy more stuff because prices are lower. So if that's the case, then I'm going to stop spending because I can wait for tomorrow if the price go down. Jess and Ev will stop spending, and then the economy grinds to a halt.
Right. It becomes a self-fulfilling prophecy.
Mm-hmm.
Exactly. And so rather than saying, oh, well, let's see if we can just have general price stability, it's been easier to target a small level of inflation. That's the argument.
Yeah, and I guess the interesting thing you touched a little bit about on technology, like what technology seems to be deflationary. I mean, you think of Airbnb or Uber. When I go to the States and I jump in a taxi, it's a lot more expensive than an Uber. And so if I go, well, what am I going to do? Am I going to pay a yellow cab, or am I going to jump in a Uber? Obviously, I'm going to jump in an Uber. And that price is less. It's almost as though that technology isn't inflationary. It's not costing me more. It's actually costing me less. Is that going to kind of impact? Do you think that's going to impact inflation going forward, or price increases going forward for the benefit of consumer? Because now all of a sudden, if I'm paying $15 versus $20, I got an extra $5 in my pocket.
Sure. Yeah. I mean, I think technology is always a game changer, and it can morph industries into new directions. And your examples of Uber and Christoph's example of computers, being more powerful and less expensive these days. Those are all positives. In terms of the overall general inflation rate, I don't think that that's going to maybe change general pricing of goods in worldwide, but certainly it will. Different products will take different paths, and there's a lot of room to be more efficient and cut costs in that way.
Great. Well, we're unfortunately running out of time, and we still have numerous questions to get through. So maybe we'll have a follow-up show in the coming weeks. We talked a lot about, money, inflation. We didn't even get to cryptocurrency with Bitcoin.
I think we can do a whole show on that.
And I think, we actually have an industry expert coming up who's actually going to be participating in our 5th annual. Am I saying that right, Jess?
You are right.
5th annual CFA Investment Forum. That is at the Ritz-Carlton on October 11th. It's a half-day event, and we've got the theme this year is really all about money. So various forms of money. We've got some fantastic speakers coming down. You can check out or register online at CaymanInvestmentForum.com. So go check that out. The speaker lineup's there. There'll be some people on Bitcoin, cryptocurrency, and we'll hopefully get a couple of these panelists on our show, and hopefully they can solve some of these bigger, deeper questions. So we thank you for your questions. Please keep them coming, and have a great day.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.